if we can make gold really accessible to people in a trusted fashion, which is the real difficulty, right? If you have something that's not a physical bar, if it's backed by a physical bar, or it's a promise that the physical bar is there, that's where a problem occurs. How do you build that trust? But it's possible. It's clearly possible.
Welcome to Smarter Markets, a weekly podcast featuring the icons and entrepreneurs of technology, commodities, and finance, ranting on the inadequacies of our systems and riffing on ideas for how to solve them. Together, we examine the questions: are we facing a crisis of information or a crisis of trust? And will building smarter markets be the antidote? This episode is brought to you in part by Abax Exchange, bringing better price discovery and risk management tools to navigate today's commodities markets through centrally cleared, physically deliverable futures contracts in energy, environmental, and battery metals markets. Smarter Markets are here.
Welcome back to Gold for the 21st Century on Smarter Markets. I'm Dave Greely, Chief Economist at Abax Technologies. Our guest today is Steve Lowe, former Managing Director and co-head of Global Base and Precious Metals at Scotiabank. We'll be discussing his experience and insights into the gold markets from his time leading the iconic Scotia Metals business. We'll also be discussing what market infrastructure and technology the gold market needs now, and what could be the opportunity for the next iconic gold business of the 21st century. Hello, Steve. Welcome back to Smarter Markets.
Always a pleasure to be here, David.
Pleasure to have you here, and it's a pleasure to have you here for a full episode after you were with us last time on our holiday special back in December. And I wanted to talk with you because you spent 20 years of your career at Scotiabank, where you led its metals business. And at that time, the gold business at Scotia was iconic. And I wanted to ask you, when you look back at it, what made that business so special and so successful?
It's an interesting you use the word iconic because at some point, Scotiabank put the business up for sale. And the pitch book, the first word on it was iconic. So it was a bit. And, sort of back, I guess, through 2000 through 2018, when the business was ultimately sold, it was iconic. There were sort of three big players in the market. So there was us, Scotia, and JP. And really what made our franchise so successful, and it was very successful. I saw the stats. It was the most profitable precious metals business on the street by a long way from some others. And it really was its scope. So, which comes with some difficulties, but we had more people and a broader business than anybody by far. So, we had, I think, 120 front office people, which if you took the next five, they still wouldn't add up to 120. And most of that was because we were deeply involved in the physical business. So we were the largest mover of gold in the world. We controlled, wrong word, we're the dominant supplier in numerous markets, big markets, India, China, Turkey at the time. And so that really provided the backbone of our franchise. I remember in 2002, we had a new gentleman come in to head the business. And the first piece of advice he got from everyone in the business is, whatever you do, don't stop us in the physical business. It's the backbone of everything. If you think about the overall business model at a simple level, we had a big operation in North America. It would deal with the mining companies. That's great. They would take all that doré, they would ship it to Europe where it would get refined, and then we'd ship it to China where it got sold, right? And so what the issue was, firstly, we were a big financing bank, massive balance sheet. So we financed it right from the ground all the way through to in jewelry stores. So, the bank had that privilege, and the bank thought itself, and it was very good at credit risk. So it took a lot of credit risk, but also it took gold as security all the way down the value chain. It came up with 1,000 different structures to feel like it was a decent lender of metal. But we also, as the metal changed form from doré to bars to jewelry to whatever, we would take our pound of flesh along the way. But we just had such broad business. We were physical, we were ETF creators, we were traders. We did a lot of things. We were clearers. And so what we particularly liked, if one part of the business was slow, generally another part of the business was active. So when prices came down, everyone, well, that's too bad. But no, we'd see huge physical demand. Prices would skyrocket and physical demand would completely dry up. But there'd be lots of trading going on. There'd be lots of people desperate for credit lines to do their business. Scrap would be coming in. And so it's just that broad scope of the business which made us successful. And again, this is maybe playing to my own ego. It was managed well in terms of there were 3 heads in each of the regions, and we got along really well. And we had one unified focus, which was clients. We focus on clients. Whatever they want is what they get. We don't fight territorial battles. So if a client says, I want to be serviced out of Hong Kong, and it's a North American client, he gets serviced out of Hong Kong. We don't really care. And a client would say to us, he would talk about one of our competitors, and we'd say, oh, this guy's a real threat. He's a global bank. And he would say, not a chance. Like, their North American operation hates their London operation. They don't talk. They dispute all the time. And he referred to us as the Borg from Star Trek, because he said, Steve, if I tell you a piece of information here, I know that my guy in Asia doesn't need to tell your Asian head. Information gets disseminated right away. You guys understand my business. It's not really an issue. And then I'll stop talking about it because I talk about it for years. We went deep with clients, right? It's like we understood their business. If anyone's out there listening to this for the first time, you want to know how to run a business, focus on your clients and what they want and really understand their business, right? So we did that. And we had clients for 30, 40, 50 years. They would never leave us. And we built the internal infrastructure to understand their business. So you work for a large institution. I may understand their business, but unless the credit people understand, the risk people understand, unless as a bank or as a provider, you don't have a natural understanding of the business. And we saw it over and over again when institutions, they wouldn't necessarily leave us, but they diversify their operating and they say, oh, we got another bank on board. And they would be like, oh, would you mind teaching that other bank about our business, how it's run and how to understand credit and why they're looking at it incorrectly? And I'm like, no, I'm not going to, but I understand your problem. So in Scotia, that was kind of our, people used to say, and all the time, especially when we went to sell the business, they were like, what is Scotia's secret sauce? No one really understood what the secret sauce is. Like, how does it all work? And it just was that we were everywhere in the value chain in gold. We were not only financing it, but we were taking some spread along the way. And we deeply, deeply understood what our clients were trying to do.
And that deep understanding, how much of that was driven by the fact that the business was so, not spread, but so broad across the value chain? Because a lot of folks will be in the physical market or they'll be in the financial market. Being able to do both well seems like a rare thing.
And to be fair, it was a rare thing. And you're quite right in terms of it was a unique advantage we had in the marketplace because we were so broad and spread out and as an institution prepared to do pretty well everything. And that was rare and got us great insights into clients. But saying that, clients are driven by, same. They needed financing, they needed risk management. It wasn't so overly complicated. But to be able to service them as a one-shop provider, which again, clients would say, oh, I love coming to you because I can get everything done. Like I don't have to. And in the world of trying to open up new accounts and having 4 or 5 different counterparts and now the demands that financial institutions make on clients, it's good to have a one-stop shop until that one-stop shuts down.
It is part of what makes it rarer now post-financial crisis, Dodd-Frank in the US. Like, was the regulatory environment just making that harder over time, or was there something else?
No, it was making it harder over time. And let's be clear, ultimately, Scotia's exit from the business was really driven by a fear of regulation. Scotia ultimately decided to sell the business in about 2016, 2017. And even at that time, it was a great business. There was no issues. It made hundreds and hundreds and hundreds of millions of dollars. It had literally no VAR risk. So it had, in terms of trading risk, it had less than $5 million of trading risk. It had significant credit risk, but as I said, Scotia considered itself exceedingly good at credit risk. It didn't mind that. What it didn't like, or what the environment at the time was, the regulators were coming down hard and putting extraordinarily large fines on businesses that weren't tightly controlled, right? So the infamous one, the one that maybe threw Scotia over, the 10 billion fine of BNP in 2000, and I can't remember the exact time, 16, for, not having the right procedures and controls in place and, aiding and embedding money laundering in certain jurisdictions. And so, the CEO of the bank said, okay, Scotia, and we were Scotia Mercata at the time, you work in what were considered high-risk jurisdictions. We had big businesses in the Middle East. We had big businesses in Turkey. At one point, we had a big business in Russia. And so the bank would look at that and say, you work in high-risk jurisdictions on a high-risk product. Gold's always considered high risk. And you deal in physical, which is kind of the higher risk of the high risk. And so they lived in fear of, well, wait a minute, if we get this wrong, the risk reward is so heavily skewed now to, if I get it wrong and you guys haven't done the necessary due diligence, or, my fine isn't 100 million, it's $1 billion. And so they took the view that that risk reward scenario just didn't work anymore. We tried to make, as the business, the argument, well, listen, we run a pretty tight ship here. We do all the things we need to do. We're well ahead of the curve in terms of what needs to be done. But more importantly, which kind of fell on deaf ears, we have an exceedingly experienced staff who now knows, you know what? That sounds really good, but it's a bit fishy. Like, I've been around for 20 years. That's not going to work. And equally as important, we made a lot of money, which only means we didn't have to pick and choose what business we did, right? We weren't desperate for, we got to hit the P&L. It's like, no, we're the established franchise. The people come to us. So if some guy comes and it looks a little fishy, just turn him away. There's no reason to do that business. And I can give you numerous examples where we turned away business that other institutions did and got themselves into trouble. It's just like, well, because they didn't understand. And we did understand. That was our argument to management. We really understand this business, and it's great business. And it's totally counter-cyclical to the bank, right? As we see now with the price action, when the world is having trouble, when other businesses may be kind of having difficulties, we'll make money, right? So it was great for the bank in terms of totally counter-cyclical to earnings. Not so great if you worked in the business and were trying to get paid, because you just got a flat salary all the time. Because when you had a great year, the bank generally had a pretty bad year, right? But flip side, when the bank had a great year, you probably didn't have a great year because gold pretty benign, right? And so it's fine. It didn't, in the big scheme of life, wasn't really too much to worry about. But yeah, so to answer your question though, that's regulation was a big factor, and the costs associated with regulation, right? When you have a franchise that deep, somebody says, oh, just implement Dodd-Frank. As anybody in a big institution knows, we had liquidity capital ratios and NSFR. We had a whole bunch of things coming at us at the same time. But that was across all business lines.
And so regulatory risk ended up being the big risk, even though you felt you had it well managed in terms of the underlying exposure to bad things, because you didn't have to take business. Credit risk, the bank knew how to manage. I think some people might find it surprising that the actual price risk was fairly small given the diversification. Like, for people who don't understand what a business like yours would do, what were customers coming to you for, and who were those customers, and how did that let you have so little kind of overall market price exposure?
I'll tell you a few little anecdotal stories as we go along, but most of the customers were sectors we didn't deal with. We didn't deal with hedge funds. We weren't traders, right? So there's a whole sector of that investment side which was of no interest to us. No interest to us because ultimately they demanded our liquidity and weren't willing to pay for it. So we said, I'm not going to be a whipping boy for a hedge fund. If you need to dump 200,000 ounces, I'm going to be the guy taking it. I don't need that business. And the people that take that business are generally trading around it. Joe's just dumped 200,000 ounces. I've just executed that. I should probably dump 10,000 because he probably knows something, right? That business was just totally what we were not geared for. And so we were geared for dealing with real users in the marketplace. So our big clienteles were either miners or refiners or jewelers, right? Follow physical flows. That's where we are. And I would say that 50% of our income was lending spread. And we can go into the ins and outs, which I find fascinating because I'm a bit of a gold nerd in terms of how the lending market really works, right? This is, you can lend gold, but you got to borrow it from somewhere. Where do you borrow it from? And how does that process work, right? And so we had a whole business that dealt with central banks because they sit on gold. So I need to borrow it. That's fine. How do you liaise with a central bank at a sufficiently robust level to let him lend you potentially $1 billion worth of gold? And so there's that whole sector of the marketplace, which we had a whole team. All they did was manage borrowing and liquidity for us. And we can tell you frightening stories, which almost comes to mind recently. When liquidity dries up, it's really not a pleasant experience if you're in the marketplace. And I would say there's probably 2 instances in my career where I thought the gold market literally might blow up. There was no liquidity. And as a big lender, probably the biggest lender in the gold market, and we had tens of billions of dollars of loans, but we had to finance it. And so you can't finance it through dollars. You actually need gold. And so when that liquidity dries up, biggest example being in literally 1999, I think it was, when there was something called the Central Bank Accord that came out, where central banks who had been aggressive lenders of the market and figured actually lending it to miners that are hedging and pre-selling it was actually bad for the price and suppressing it. So they decided collectively we should just not lend gold anymore. Well, that was a bit earth-shattering to franchises like ours. It's like, well, ooh, I got to borrow $20 billion worth of gold. And suddenly it's not available. And so, you immediately see gold lease rates spike out. And we should have a conversation on gold lease rates because they're sort of this opaque, incredibly important number in the marketplace. But suddenly lease rates are at, call it 10%. We've got no liquidity. And I'm not particularly at risk. I'm not one of those banks where you see these instances where I borrow short, lend long, get a spread. That's not the way we operate. We borrow short, lend short. That's the way it works. But I've got $20 billion worth of clients looking for lending, and I may have to shut that down because I can't get liquidity. So did at the time, me and my boss, march on into both the governor of the Bank of England and the governor of the Bank of Canada, so our domestic marketplaces, and say, listen, we got a problem you're not really aware of, but if I can't lend and I call all my loans, there's going to be chaos in the gold market temporarily. People will, but everyone's going to have to buy that gold back. It's going to be basically pandemonium. We had a decent audience from both governors, so that's a problem. The Bank of England more so because the market was basically, everyone views the domestic, the gold market's housed in London. And we're saying, well, this is basically not quite a doomsday scenario, but a pretty important one. We need liquidity. At that point, the UK still had a bunch of gold and said, so you may have to provide us emergency funding for this. And the situation ended up resolving itself. Not through that, although I'm always secretly suspicious that a little while later, a bunch of big lenders, other central banks of the world came in to lend, who had traditionally not been big lenders. So the market corrected itself. But those kind of incidents, and we saw that instance recently, when this dislocation in New York and all the gold moving out of London and gold lease rates spiked. And they seem to probably the most people, it's like, yeah, whatever, who cares? But if you're the banker who has a franchise like ours, those are panic times. And I keep telling people, like, if you're going to trade the gold market at some level, you really need to start to understand these things, right? In that environment, who's making money, who's not making money, who's bleeding money? You think banks are making money. You think refiners are making money because they're making bars and shipping them to New York. That must be a good business. They're panicked because lease rates are at 10% and they don't know what to do about it.
Yeah, and I'd love to go into the lease rate piece because in this series, we're talking about gold for the 21st century and gold's role and potential role in the financial system. And people will look at LIBOR, SOFR, overnight lending rates. They'll look at the 3-month T-bill rate. Like, people are very attuned to, like, okay, I need to look at certain short-term lending rates, and that's signs of financial stress. And they understand why that's important. The lease rate, people think it's esoteric and, no need to think about it. Can you explain to them why you need to understand what the gold lease rate is and what it's telling you?
Just for what you just said, the gold lease rate is a harbinger of trouble, right? If the gold lease rate is, and it's traditionally, let's just say for argument, it's traditionally been 50 basis points, although that is not quite legitimate. It doesn't really matter. Let's say it's 50, and suddenly you see it at 1%, right? You should be raising an eyebrow and saying, something's going on, right? And if it's at 2%, you should be raising both eyebrows and going, wow, something really is going on. And if you're in the marketplace, not so much potentially as sort of a retail smaller player, but if you're marginally a wholesale or a big institutional player, you should start to really ask some questions. Like, what is going on? That is so unusual. There's something amiss, right? And then you say, oh, okay, it's people warming up for a potential Trump tariff on gold. I get it now. I sort of see it, right? And therefore, then you factor that into your risk analysis. But if you haven't, you should be. But, and again, I'm sure we'll get to this later. You want to try and find a gold lease rate as a normal layman? Like, I can't get one. I'm kind of curious. I'm just going to Google it or, use my AI to figure it out. Nothing. Like, absolutely nothing in terms of relevant lease rates today. If you have a Bloomberg screen, you can probably get something pretty close, right? But that's a very small circle of people. And so, yeah, it's just one of those things. And overall, the gold market is a fairly complex beast. I always used to tell sort of junior people that come into the bank, like, you're really not going to be useful for 6 months. You think you're going to be useful, but you're not, because to really understand the intricacies of the gold market and just the jargon of talking about the gold market, it's going to take you a while. It's fidgety, very fidgety. And the gold lease rate is one of those components that people just don't pay attention to. And they should. Again, depending on where you are sit in the market. But if you're a trader or if you're just in the business, you should always have an eye on lease rates. And most of the time, they're nice and benign. And you think, okay, that's good. It's where I like it to be. And so for a long period of time, gold lease rates were negative, right? Which again, people go, how can that be? So I can, as a big financial institution, I can borrow gold for a negative interest rate. For a guy who has big inventories around the world and, likes to deal in physical, that's a pretty sweet deal if I can actually borrow at a negative interest rate. And it was borrowing at a negative interest rate because at that point, hedge funds and various people were going long gold and had to pay storage for it. So I don't want to pay some bank 20 basis points for storage. Why don't I lend it to Scotia at -5? I've reduced, I've saved 75% of my cost. And it's a nice big AA rated bank. So, but when gold lease rates went from negative to positive, you realize something's happening. You should know.
And for people who aren't familiar, the gold lease rate is basically the interest rate that you pay for gold in gold, right? So like effectively it would be if I borrow an ounce of gold at 2%, I need to return 1.02 ounces of gold.
Absolutely. But it's denominated in gold, usually paid in gold. Not always. If you really want, you can get paid in dollars. But it is effectively the interest rate for you who are a holder of gold for me to borrow that gold. And I want that gold. So if you are an institutional investor and you've got 100,000 ounces of gold, where is it? You want to go long gold. Are you holding it in an allocated account in a vault? That's going to cost you a lot of money. So you're probably holding it at what we will refer to as an unallocated account at a clearing bank. They're going to still charge you, but charge you less. But if you really want to make money, lend it to me as a bank. And that gold actually moves from clearing account to my account, and then I can do what I want with them.
And so who are the active participants in that gold lending market? You mentioned central banks are kind of a source of lending or could be a source of lending at points in time. Who are the people that are, I guess, on the borrowing side of that market?
Pretty well everybody in the gold value chain. So just start with a miner. So a gold miner, right? So his ultimate goal in life to a certain extent at a very base level is revenue recognition. I need to have as much revenue as I can in the quarter. So as a quarter end approaches, he's like, oh, wouldn't it be good if I could sell this gold that isn't quite gold yet? It's kind of either gold on the way or it's gold that's left in my mine, but on its way to a refiner. So I'd like to be able to classify that as gold and sell it. So big institutions like ourselves, we say, okay, I'll come and buy pretty well that dirt in the ground. It's not in the ground at this point. It's usually on its way somewhere, right? But it's not properly turned gold. But for a big financial institution to do that, right? So I'll sell you today, I'll monetize that price risk, but then I have to borrow gold somewhere in the marketplace to sell it to monetize that value. So most miners of the world are borrowing gold just at the fringes of when that gold is at the refinery. They don't really want to wait for outturn till it's nice, pretty gold bars to then sell it in the marketplace. If they can pinch a day, a two, a week, they do. And they all do. Fair enough. It's fair game. And then our big client base was refineries, gold refineries. So there are, I say, 15 huge big gold refineries in the world. They're all well known. I mean, there are 100 gold refineries, but probably 15 big major gold refineries, the big four in Switzerland. And ultimately, they don't have the working capital to process the amount of golds they do. So they need to borrow that. So ultimately, the mine will send it to the refiner, and the refiner will say, okay, this is now in theory my gold. At this point, we use Scotia as the name Scotia. Well, by the way, can I borrow that from you too? And so we would have the miner as a lender, then we'd have the refiner as the lender. So basically, all through the value chain, someone needs to borrow the gold to lend it to them because very few people have the working capital because gold is so expensive. So every jeweler in the world is probably borrowing gold. And by borrowing gold, as opposed to borrowing currency, which you can also do, you eliminate the price risk associated with borrowing dollars. So if you're a jeweler and you're making a gold ring, you have the choice. I either buy the gold today, right? And I make a ring and I sell it in a month. But gold is really sold in most places of the world by weight. And so he's very, very reliant on what the price is in a month. Could be up, could make a lot more money, could be down. And I've actually lost money making a ring. That sucks. So he needs to borrow the gold from a financial institution who will then say, I'll lend you the gold today. You make the ring. And the day you sell the ring, you get your money, you buy the gold from me, and you repay your loan. So the jeweler's just worried about making rings and his 10% spread, and he has to borrow it as opposed to any type of price risk. And so refiners and jewelers basically borrow all of their gold.
And while the ring and the refined bar may be very expensive, the spread or the margin that the refiner or the jeweler makes is not relative to the volatility in the price, right?
I ultimately, especially for my refiner friends, I've got many of them, I always felt like, they're dealing with such a high value commodity and someone's making a lot of money between taking gold out of the ground and selling it as a ring in Tiffany's or whatever. It ain't the refiner in the middle, I'll tell you that. Generally the miner or the jeweler who are taking most of the spread out of the value chain.
And I wanted to ask you, you had mentioned the market in 99. Obviously, the gold market recently, volatile, big increase in price. What are you making of the current price action in the gold market?
To my mind, gold is totally behaving as it should, right? So, I mean, as I'm sure it's a crazy market. We'll look at it. So it's a crazy world in terms of geopolitically what's going on. And you wake up today and it's different than what happened just today. And it's going to be different what's going on tomorrow. And so to try to assess all of that, you see massive market volatility where you see it in gold. But what collectively you see is collectively in terms of globally, gold is acting as the appropriate safe haven, but not just to probably less so to Americans, but to every other nation. Like there are no nations that aren't moving into gold. So collectively, if everyone is seeing gold as a safe haven, people used to see US dollars as a safe haven. Well, that trade is a little bit more dubious now. So your Eastern nations who may buy US treasuries are now just putting money into gold. So you see huge demand from China and retail, both retail and the central bank is buying, but you see it across all different countries. And so it's not surprising that gold is where it is. No surprise whatsoever. And the volatility, which I find staggering, really, but it's the same in equities. You look at Tesla. I'd find it very hard to be a trader these days. I would just sit on my hands and I just can't deal with it. There's no real trends. Total headline news. What is the man in the White House going to say today? And I'm going to see 10% up or 10% down. But wholeheartedly, gold's to me, it does represent a safe haven. It's where money is going. I get it. It'll stay that way for a period of time. I'm not a price. But if the world becomes a better place tomorrow, then you'll see what's happened in gold the last couple of days. It'll be down $200-$300 because everyone thinks, it's fine now. I'm not sure it is.
And when you look at all the money that's going into and then sometimes out of and into the gold market, more into than out of recently, and people, as you said, globally looking for an alternative safe haven to the US dollar, when you look at the infrastructure that's available in the gold market to handle those types of flows and that increasing use, how do you assess it and what do you think is needed?
I don't give it a very good mark. And to me, it's a real shame that I'll call it gold is having its day, so to speak, in terms of as an asset class. And maybe it's the beginning of a day that lasts for centuries. I don't know. But overall, the infrastructure and the way gold trades is still incredibly fragmented, incredibly opaque, and just incredibly difficult to do. And I think maybe we'll talk later about various technologies and various people that are trying to do certain things. The World Gold Council will call it as sort of the main driver of trying to build demand and ecosystem in the gold market. They acknowledge completely that if infrastructure and transparency and all these things were in the market, and if the infrastructure for people was there to allow them to trade, I mean, demand would be twice as much, right? I mean, people always find a way, so maybe not twice as much, but the gold market's really missed a trick in terms of evolving. Your gold trades exactly the same way it trades when I started to the market, which is a long time ago. Nothing really has progressed. And there's been lots of, we've got a gold token here, we've got this there, but overarchingly, nothing has really changed. I can tell you, because I looked at it recently, I want to invest in gold. It's so tricky in terms of how to do it, and it just shouldn't be, right? It should be a no-brainer. I should be able to go to anywhere trusted, and even here for me to buy like a DTF, it's just complicated, and it just shouldn't be. And it should be so straightforward, but it's not.
And why do you think it's not? What's standing in the way?
That's the old, if it ain't broke, don't fix it. And it's a really good question in terms of why the drive, because you think, okay, there's enough demand. Why aren't people clamoring for an easier way to do it? And I just think they look and they just put their money elsewhere. Like, okay, I won't buy gold. I'll buy a gold mining stock. It's so much easier to do that. There are a lot of, from an institutional, big players who are just very sedentary and very happy in their business lines and don't feel a compelling need to change anything because they're making money. And the sort of the concept of changing everything to build a bigger pot, it almost goes against their human nature. I don't want to build a bigger pot. I got a pretty good share of this pot. So I can guess that I might build a bigger pot, but I might put some of my pot at risk. And I'm not sure I'm going to do that. And quite frankly, my pot's big enough. So I'm just going to do that. But that's at a very institutional level. And as I said, it's a fidgety business, right? It's an asset class that has different forms, different purities. There is an issue with traceability in terms of, okay, where did it come from? So it's not so straightforward in terms of dollars. Currency trades are easy. Asset trades are easy. Gold's a bit messy.
Well, and I imagine for a guy like you who is used to kind of working from the financial side through to the physical side, that's the part that seems very challenging now. Like people can go and buy an ETF or they can buy gold futures and say, well, I'm invested in gold. But it's when you're trying to look through and say, okay, how do I get from that into the physical side or from the physical side back into the financial side? That seems to be where the challenge is. Is that right? Or am I off base?
That's 100% right. 100% right. And it's, if you just want price exposure to gold, that's not that difficult to get. If you want to actually own physical gold, that's a little trickier in terms of how do you do that. And then to tie the two together is very difficult. Lots of organizations, and we'll get back to the World Gold Council again, who has this concept of a standardized gold unit, right? Which we can read about, which is basically trying to basically move those two things away, right? Gold is gold. It can be any form, anywhere in the world. It's just gold. Great. And then if you want the physical attributes of the gold, that's a completely separate vehicle that we need to worry about. Because I get annoyed with people when they say gold is fungible. Well, gold isn't really fungible because a kilo bar in Singapore trades at a vastly different price than a bar in New York. It's very location specific. So, well, gold, yes, it's 99 whatever percent pure, but in terms of its physicalness, not fungible in the slightest. And how do you then take that leap from sort of the financial world to the physical world? Quite candidly, it's something that no one's really cracked. And, the ETFs claim, which is certainly kind of true, if you buy the big GLD ETF, you can redeem it for physical. Well, you can redeem it for physical if you have a clearing account with one of the big clearing firms, which obviously most people don't. So it's not really redeemable for physical. And the gold market, as a general rule, despite the financial players who want it, is full of people who mistrust the system. That's why they buy gold, right? And so they don't want an ETF. I know, because that not only that, it's being custodied here. I've got to go through this financial institution. There's also another. I don't like that. I want the bar, right? I want to feel comfortable that there's a bar somewhere that has my name on it, that it's in a trusted place that I can get, because I think the end of the world may come. So I want that. That's extraordinarily difficult to do. We're working on it.
And I wanted to ask you about a piece of that because there's, as you said, on the one hand, the push of gold is gold. And like any other commodity, what we've seen is commodities becoming a little bit decommoditized, right? Location matters. The kilo bar in Singapore is not the same as the 100 ounce in New York. And at the same time, people may or may not care more and more about where the gold originally comes from. And so there's the trust of, is the gold bar I have really a gold bar or is it something else? And there's also, where did this come from? Maybe, maybe not. I'll pay more if it was produced in a way that's in accordance with my own values and ethical standards. What are you seeing on the technology side for making gold more trustworthy?
Yeah. I mean, I could wax lyrically about that particular gem of a problem, right? And not only the technology that's trying to solve it, but much more importantly, do people care really? And even more importantly, they may care, are they willing to pay for it, right? And so there's a tremendous amount of great work going on in terms of traceability solutions. And again, part of the supply of gold, so there's traceability, and that traceability is mostly focused on large scale mines, right? And then there's a whole artisanal mining sector, which again, you can do another whole podcast on in terms of trying to legitimize and bring artisanal mining into the system. But for the purpose of this conversation, we'll leave that out because that's another chestnut too far. But there are some good solutions and some actually really cool technology in terms of the way to look at traceability, in terms of different refiners have different ones. I'm involved with a company which creates a digital twin, and you follow that, helps efficiently move information down the value chain, because that's important in terms of ultimately, if I get a bar, I would love to be able to scan the bar and have all the information about where that came from. So we're really close to that, right? And so that is going to happen, right? The next step of, okay, now I've got a gold ring. I'd really like to be able to scan that and find out where that comes from. We're not that far from that. And again, there's technologies of inserting atoms, which are markers, into jewelry. But the traceability one, I find sort of interesting. And I guess part of my problem is as always, it's too fragmented. There are too many people doing two different things, and the market gets a little diluted. And therefore, there's not one winner. There's 5 guys that fail. And the market needs to be more aware and acknowledging that, we need to back a solution because we can't. But there's also, there's these, we call them geoforensic passports or geoblocks. We have the technology now that if I give you a piece of dirt that comes from a gold mine, you can scan it and they can tell you, they make the rule that within 500 meters of where that doré came from in the world, right? We're not quite there, but we're pretty close. And so people get comfort that, okay, this doré that has made its way to refining, it's been scanned. And it has the 212 different elements down to the 1/1 billionth of something that says that came from this mine shaft in this country. And very importantly, it hasn't been blended with any other material. It hasn't come from the other side of the river, which is illegal mining. And so that technology exists. It's a matter of, we're kind of at the stage where it all needs to come together in one beautiful platform that the industry adopts and it becomes the norm. And we're not there yet. And people are still sort of, fighting's the wrong word. It's quite rightly, people get proprietary about their technology. They don't want to share it. And this is better than mine. We should use mine. And it becomes a marketplace. But we will get there. My big focus now is, okay, so we have this technology. It's great. How much information needs to be associated with a gold bar, right? And there's an element of confidentiality around that. Where did it come from? How was it shipped? Who was it shipped by? Great. You're not going to have that level of information, but it's available, right? So you have all that. But then what is kind of the lowest standard of consumable information that people fundamentally care about, right? It came from Canada and it was mined ethically. That's good enough. Or no, I want it to be mined better in this country, in this way, transported in this way. All of that information is available. The market hasn't decided what it wants to consume, and more importantly, whether it will pay for it, right? So there are lots of funds, ESG, ETFs that market themselves as responsible. But at the end of the day, if you go in and cold-bloodedly ask them, you need to pay X, they are still so return focused. Ooh, that's going to charge me like 10 basis points off my return. I'm not prepared to do that. Please come back when it's 1 basis point and then I'll talk to you, right? And their customers aren't demanding it. It will come, I have no doubt, maybe with a slight hiccup now with a sort of where is the pendulum on ESG and DEI? And it seems to be maybe swinging back a little, but I have no doubt it will come back and people will care. They're going to care, candidly, because they're getting regulated to care, which is kind of what is slowly happening, especially in the European marketplace, where if you are an ETF creator and you are holding a gold bar as custody for a fund, you now have a whole new set of regulations around. You need to know where that bar came from. It needs to be what I'll call a documented bar. You need to have all the information about how that bar came to existence. And that's a relatively new regulation, which will drive the adoption of a lot of these technologies. Because ultimately, that is the driver. I'm going to get a regulatory fine. I better pay 10 basis points. I really wanted it at 1 basis point, but you know what? I better pay 10. And that is slowly happening, right? And specifically in the European marketplace. Hasn't really been adopted in the US or other parts of the world, but it will. I have no doubt it will.
Well, I want to ask you one more question. First, I could talk with you for hours, so I'm like trying to cut that off. But thinking about the future, this is our series on gold for the 21st century. So before you go, I do want to ask you, when you think about the role that gold could play in our future, what do you think that role could be? And given our conversation about your career at Scotia, what do you think the next iconic gold business could be?
I think literally gold plays the role it should play. Okay. So people, my wife included, always says, why does gold have any value whatsoever? Like it's just a thing, right? It's just a scarce commodity. Like I have no, why do we kind of, as my wife would say, is fairly left, rape and pillage the earth to mine this thing that nobody uses. It's just a store of wealth. And I hate to say it just because it is, right? It's been a store of wealth and something that people have wanted and has really retained that wealth for thousands of years. So if you need a safe haven, if you really need somewhere to park your money, I can't believe there's any long-term better asset than gold. I mean, there's obviously over periods of time, yes, real estate's good. Gold is a great place to just do that. So in terms of, I don't think that role will change. Will it be a foundation for currency? We will go back to that. In my opinion, not a chance, right? It's just not going to. There's not enough. It's not intricate enough. But will it remain this slightly esoteric asset class that people invest in this store? Absolutely. The next great trade and what people are doing is to just build the system and the rails and the ability for people to do that properly. And, working with various companies to try to do that because it's such a no-brainer. If we can make gold really accessible to people in a trusted fashion, which is the real difficulty, right? If you have something that's not a physical bar, if it's backed by a physical bar or it's a promise that the physical bar is there, that's where a problem occurs. How do you build that trust? But it's possible. It's clearly possible. If you can design that and build that, and I don't know, and gold price will skyrocket for the first part because people have ready access to it in a super liquid market, and that's a global market. That's its role. And it's a great role. Not going to change.
Thanks again to Steve Lowe, former managing director and co-head of global base and precious metals at Scotiabank. We hope you enjoyed the episode. We'll be back next week with another episode of Gold for the 21st Century. We hope you'll join us.
This episode is brought to you in part by Abax Exchange, bringing better price discovery and risk management tools to navigate today's commodities markets through centrally cleared, physically deliverable futures contracts in energy, environmental, and battery metals markets. Smarter Markets are here. Contact us at sales@abax.exchange to get started. That concludes this week's episode of Smarter Markets by Abax. For episode transcripts and additional episode information, including research, editorial, and video content, please visit smartermarkets.media. Please help more people discover the podcast by leaving a review on Apple Podcast, Spotify, YouTube, or your favorite podcast platform. Smarter Markets is presented for informational and entertainment purposes only. The information presented on Smarter Markets should not be construed as investment advice. Always consult a licensed investment professional before making investment decisions. The views and opinions expressed on Smarter Markets are those of the participants and do not necessarily reflect those of the show's hosts or producer. Smarter Markets, its hosts, guests, employees, and producer, Abax Technologies, shall not be held liable for losses resulting from investment decisions based on informational viewpoints presented on Smarter Markets. Thank you for listening, and please join us again next week.